People talk about credit scores like they are some kind of adult life grade. One number goes up, one number goes down, and suddenly it feels like your whole financial identity is being judged. That framing makes credit feel more mysterious than it needs to be. A credit score is not measuring whether you are a good person or whether you are smart with money in every area. It is measuring how risky you look as a borrower based on patterns in your credit history. A credit score is a shorthand estimate used by lenders. It helps them guess how likely you are to repay borrowed money on time. That is the key idea. A credit score is about borrowing behavior, not your income, your savings, your personality, or how hard you work. Once you understand that, the number becomes easier to interpret and much less emotionally loaded. Credit scores are usually shaped by a few major categories: whether you pay on time, how much of your available credit you are using, how long your accounts have been open, what kinds of credit accounts you have, and how often you apply for new credit. Different scoring systems weight those factors differently, but the broad pattern stays similar. Lenders want signs of stability, consistency, and repayment. That's why someone can make decent money and still have a weak credit score, while someone with less income can have a stronger one. The score is not asking how much do you earn, it is asking what does your borrowing history suggest about how you handle debt. That's also why no credit history and bad credit history are not the same. No history means the system does not have enough information yet. Bad history means it has information that looks risky. One of the biggest misunderstandings is the idea that carrying a balance automatically helps your score. What helps is using credit responsibly and paying as agreed. Carrying debt and paying interest is not a secret score-building strategy. It is usually just an expensive misunderstanding. Imagine Alana gets her first starter credit card with a $500 limit. She uses it for groceries and one streaming bill, then pays it off every month. Her friend assumes she should leave part of the balance unpaid to show activity. If Alana follows that advice, she may start paying interest for no real benefit. What actually helps more is predictable use, low utilization, and on-time payments. Now imagine another person applies for 4 different store cards in 1 month because each one offers a discount. That might feel harmless in the moment, but it can make their credit profile look more unstable. The score is reacting to patterns, not isolated explanations. Picture a landlord looking at a short rental history for 2 applicants. One has a record of paying on time, not stretching the lease too thin, and staying stable over time. The other has scattered payments, new obligations appearing quickly, and less consistency. A credit score works like a compressed version of that judgment for debt. Another useful image is a dashboard with a few gauges, not one moral score. Payment history is one gauge, utilization is another, account age is another. If one gauge slips, the whole number may move, but the system is still describing patterns, not your worth. Pay every credit account on time, even if it's only the minimum, while you are stabilizing. Second, keep credit utilization lower than it needs to be by paying down balances before they grow large relative to your limits. Third, don't open random accounts just because someone offers a small sign-up perk. Fourth, check your credit reports for errors so you are not reacting to bad data. Fifth, remember that score building is usually slow and boring. That's good. Boring systems are easier to manage than dramatic ones. If credit has felt intimidating, try replacing shame with accuracy. A credit score is just a risk model built from limited signals. Ask yourself, what behaviors is this number actually rewarding, and which of those behaviors can I control this month? That question puts the focus back on action instead of anxiety. If this helped, subscribe to Finance Keys, drop one credit question you want answered next, and share this with someone trying to understand credit without the hype.